Heroes from SD Bullion, the coin series you won't want to miss. Beginning June 2014. The Heroes SD War Collection launches June 6, 2014 with the limited collector's edition D-Day, The Longest Day. Available in brilliant uncirculated and proof versions, commemorating the 70th anniversary of the Allied Normandy invasion. Each proof will honor one of the 1,557 missing in action Americans who paid the ultimate sacrifice on D-Day. Heroes from SD Bullion, the coin series you won't want to miss. Beginning June 2014.
This is the Doc and Eric Dubin with the SD Weekly Metals and Markets. Joining us this week is Precious Metals Fund Manager Dave Kranzler. Great to have you back on the show, Dave.
Hey, thanks for having me. It's great to be back on here.
Well, we always appreciate having you and your astute analysis, particularly related to the precious metals market, but really with the macro economy in general. So I wanted to start off here with a quick recap on the metals trading this week. Gold popped back above 1,300 early in the week and looked like it might advance off the level, but was traded to a waterfall decline back through and under 1,300 on the COMEX Open. I believe it was Thursday, and then again another little bit dip here Friday. We're recording this show this week a little bit early in Friday morning, and gold's recovered off its lows from the morning to consolidate around the 1295 level, really where it's been trading around for the past 24 to 48 hours. In silver, we saw a spike up towards $20 early in the week, and then it's been a bit of a consolidation off that throughout the second half of the week, touching a low of 1920 early Friday morning, and looking like silver's headed for a close somewhere between 1940 and 1950 here on Friday. So what's your take, Dave, on the trading action in the metals this week?
Well, it's interesting that you kind of described what occurred as a consolidation. My take is that, at least for the current time period, the Federal Reserve and the bullion banks are operating in concert to do their best to keep gold below 1,300 and to keep silver below 20. And it's been kind of stuck there for several months now, kind of in a trading range on gold, kind of between 1,280 and 1,300, and on silver between 19 and 20. It kind of reminds me of back in, I guess it was 03-ish, when gold was trying to break out over 400. And I remember Robert Prechter came out and forecast that, on one of the failures at 400, he forecast gold was going back to 50, and it didn't take too long before gold was up and over 400 and on its way. So I think for now, in their efforts to prop up the U.S. dollar and to try and provide at least indicative support that their QE policy is working, they're trying to keep gold below 1,300 and silver below 20. So, and we saw that after we spiked up early this week, they immediately went to work on both metals. What's interesting to me is that it seems that on the downside, they can't get gold below 1,280, and they can't keep silver below 19. So who's ever out there buying it, and I think we all know who is, they've certainly decided that, they're going to keep buying it every time they try to take it below those two support levels.
Right. And certainly the big news this week, or the big story in the precious metals markets, was the announcement that after 100 plus years, the London fix will end on August 14th. And really, you could kind of see it coming with Deutsche Bank being unsuccessful over the past few months in selling its gold and silver fixing seat, which would really only have left HSBC and the Bank of Nova Scotia agreeing to the daily silver fix. So with only two banks remaining for the silver fix, because unlike gold, silver only had three banks participating in the fix, as Deutsche Bank was unable to find a purchaser for their seat, the announcement came this week that they're going to end the silver fix in August. So Dave, what's your take? Is this the beginning of the end of the manipulation? Is it just inevitable because Deutsche couldn't sell their seat? What's your take on the end of the silver fix?
Well, I think part of the reason was that there was only 2 banks left on silver, and I think it's kind of funny how the London gold and silver fixings are called the fixings, and yet no one connects the dots between the price fixing and the fact that they use it to fix the market. The market's rigged, and the data shows that, and it's undeniable. I think the silver side of it was easier to close down. My feeling is that, and I think closing the silver side will placate. I think they did that to placate the regulators. I personally don't think they're going to stop or end the gold fix, and maybe they will, but it really raises the question. I haven't heard anyone ask this because they in the media they talk about how they may close down the fix, but they're working on developing something to replace it. Well, why do we need a price fixing type apparatus to begin with? I mean, it automatically introduces the notion of artificiality into the market. They don't have the Shanghai Gold Exchange is the largest physical bullion market in the world now, and they don't have a price fixing, and that thing operates perfectly fine. So I'm not even really sure. The fact that they're looking for something to replace the price fixing tells you that they're grasping for ways to hold on to their ability to manipulate the market. And actually, when you think about it, it may actually be an effort to further make the manipulation efforts more opaque. I mean, they stopped publishing the silver forward rates a couple of years ago, and as we've seen, silver is by far the most manipulated market in the history of the world. So, while I think that everyone in our sector of the world kind of received the news that the fixing was being closed as a positive, to me it'll only be a real positive if they shut down the gold fix and they don't try to find something that everyone can agree on to replace it, because it automatically takes away from the idea that the market's a free trading market, which is what we need.
What's your take, Eric?
In our day of fully electronic markets, the outcry markets and futures and commodity exchanges are kind of archaic. There's really no reason why you'd want to have something along the lines of a fixing session. And one of the reasons why that system was up and running for as long as it was that it was a profit center and basic mechanics tool for the bullion banks, because they would help execute trades among mining companies who were their clients and industrial purchasers, and it was a way they would coordinate physical trade execution for the big block trades and whatnot towards the end of the day in London. London used to be the go-to place for physical trading, and as we move into the Shanghai Exchange dominance, that kind of fits with the changeover where they just see no particular need to have the fixing session. And we should also say a bit about just the nature of manipulation. The big dog in manipulation of the price of silver and gold are the dumping of paper contracts in flash raids. The heavy lifting of what executes manipulation in our sector is primarily from that, and then secondarily high-frequency trading, and then all the sentiment games that powers that be play and so forth, and then also the physical dumping of gold and silver when and where necessary to satiate demand from particularly demanding customers that are, or traders that are looking to take delivery and send it off to Swiss refiners and whatnot. So the absence of the silver fixing session in London really isn't going to make that much of a difference in terms of what's going to go forward when it comes to manipulation. It's more like a footnote along the lines of this evolving history of the manipulation blowing up. It's just going to take a lot longer for it to end. I mean, we can look back to 2004, I believe, when the Rothschilds exited the gold fixing and got rid of their seed, and these kind of things didn't have major impact in terms of what's going on with manipulation. certain extent, I think that there's a few commentators and general board posts on message boards and whatnot that are ramping up the excitement about the fact that this thing is going away. But I just caution people to not get too excited about it, because frankly, that's not where the core of the ability for the cartel to manipulate comes from. And that's really the most important point that people need to keep in mind. But at the same time, it does reflect, I suspect, the understanding by the bullion banks that if they take this out of service, that they're reducing their exposure to the prying eyes of regulators, particularly BaFin in Germany. So it reduces some of their risk. And in our modern markets, the fixing mechanism is not necessary, as Dave pointed out. And what will be the standard going forward is what we see in Shanghai's trading. So that's the main point.
I wanted to shift the focus of the show a little bit here now, Dave, to a story you've been focusing on lately, which is the Fed's money laundering for their QE program through Belgium. And it's been amazing to me over the last, month or two since the story first broke that Belgium was the big new purchaser of Treasury bonds, that even alternative sites like Zero Hedge, they didn't question where those funds were coming from. It was obvious to me, at least, that it's being funneled through the Fed. And I think you more correctly labeled it money laundering, which is really what it is they're attempting to hide or disguise their purchases of US Treasury bonds. So we had another big report this week, I think on, was it Wednesday or Thursday, of a new big purchase for Belgium. So what's your take on this story, and as far as the Fed money laundering the QE funds through Belgium, Dave?
Twofold. I mean, on the surface, the Fed has, and now, it's been tapering its QE, so it's been reducing the amount of Treasury bonds that it's been buying and the amount of mortgage bonds that it's been buying. And then, when there's a big seller of Treasury bonds, as there obviously has been, yesterday's data that was released showed that Russia was a major seller. And actually, if you take the numbers and go all the way back to November, this is off the top of my head, I don't have the numbers in front of me, China's actually sold down a fair amount of their holdings as well since November, so since the end of October. So there's been two big sellers out there, and at the same time, the Fed has been reducing the amount of Treasury bonds that it's buying. Well, it also needs a bid in the market to pay for new Treasury issuance, which has been temporarily reduced. I think we're going to see the Treasury issuance start to ramp up later this year as well. But so the Fed can't outright just print money and purchase those bonds, because everyone would see it in the visible numbers that the Fed releases bi-monthly. And it's absurd to think that the little country of Belgium has all of a sudden ramped up its holdings of U.S. Treasury bonds. And again, I don't have the numbers in front of me. I calculated them for the article that I wrote with Dr. Roberts. I think Belgium owns something like
381.
Yeah, so it's over 70% of its annual GDP is the amount of Treasury bonds it holds. And if you contrast that with the largest holder of treasuries, which is China, they hold 12% of their GDP in treasuries. So it's absurd to think that Belgium, A, would hold that much in relationship to the size of their economy, and B, Belgium has been running a trade deficit and a balance of payments deficit recently. So where did the money come from to buy those bonds? Because unlike the Fed, which can unilaterally print money, Belgium is beholden to the European Central Bank's ability or willingness to print money. And clearly that's not happening right now. So where did the money come from? Where did Belgium get the account funded? There's plenty of liquidity facilities that have been set up between the ECB and the Fed that would enable them to free up enough money to pay for the bonds, stick them in Belgium's account, use Belgium as the beard, and really the de facto buyer is the Fed, and maybe the Fed in conjunction with the ECB. I looked at some Fed balance sheet numbers yesterday, and if you look at the Fed, if if you look at the increase in the Fed's balance sheet, let me see. I'm trying to find those numbers because I pulled them out of the Fed reports and sent them to Paul Craig Roberts. But at any rate, the increase of the Fed's balance sheet between December 31st and their last report, which would be as of March 31st, the balance sheet increased greater than it should have increased if you just calculate what the increase should be according to the QE schedule. And it increased by about the same amount that equates to the amount of bonds that has been put into the Belgium sovereign account that's being held at the Fed. So, I don't know what more evidence you need, short of the Fed coming out and admitting that they're the ultimate buyers of the bonds. So that's kind of my take on it, and I think it's a way for the Fed to make sure that those bonds don't go to the open market for bid, because if all of a sudden, you got a big seller between Russia and China, you got a big seller of Treasury bonds that are being offered in the market outside of the closed Federal Reserve System, it's gonna force the market a lot lower, and you're probably gonna have a lot of selling front running that block. So if they can move the block of bonds without the market seeing it, it adds to the Fed's ability to stabilize the market, and in a way, it's really just more de facto quantitative easing.
And I think you made a good point in the article as well, that these bonds are likely being purchased with the large swap that the Fed made with the ECB back 2 or 3 years back, as it's coming through the Euroclear system.
Well, yeah, and that's a whole other interesting aspect of it, was that you can see the bonds were removed from the Fed's foreign custodial account. The trade was cleared through the Euroclear system, despite the fact that the Fed has its own clearing system that it's set up specifically for trades like that. And the reasoning is the funding has been set up in an offshore facility to pay for the bonds. We clear them through Euroclear. And then literally within about 2 or 3 weeks after you saw the big decline in the Fed custodial account, it bounces back up to where it was before the bonds were removed. So clearly the bonds were traded and cleared through Euroclear and then moved back into the Fed's custodial account for foreign governments and institutions.
Yeah, and for context too, we should say that the swap lines were never to be fully disclosed. I mean, we only know about them because of the lawsuit that Bloomberg ran and got the information out, and we learned that it was maybe as high as tens of billions.
That's correct. And actually, when I was examining the line-by-line items of the Fed's balance sheet yesterday, you could see there's an account called Other, and there's a nice increase in that account, and there isn't any footnotes that describe what is contained in Other. So there's plenty of places on balance sheet and off balance sheet where the Fed can hide the transaction, but it did have to show up in the movement in the custodial account, the movement of the bonds in and out, and the fact that it was cleared in through Euroclear, stuck in Belgium's account, and then moved back into the Fed's custodial account.
Yeah, we'll include a link to your article. Belgium adds another 40 billion of treasuries in the write-up section of today's show. But I should also just throw out here for people's context some of the numbers. In October, Belgium held $180 billion worth of U.S. Treasuries, and by the March report, it was $381 billion. Yeah, that's roughly a double. And if you look at the previous run rate over the course of 2013, it was pretty stable. There was very little movement, and then all of a sudden, Belgium just takes down what is a huge amount of Treasury bond holdings, way in excess of what was being reduced from tapering. So I think that this is the smoking gun. The numbers are here, and who knows? Maybe they might they'll deep six the tick report at some point. There's a long history of dead statistical reports that are embarrassing that the government just squashes. So don't be surprised if the tick goes missing.
All right, we wanted to give the listeners a quick update here on the state of the wholesale gold and silver market in the U.S. really haven't seen too much of a change over last week. 90% silver remains in extremely short supply across really the U.S. wholesalers, 2 to 4 weeks out, and really unavailable in any meaningfully significant quantities. Premiums pretty much unchanged across the spectrum from generic products, rounds, bars, and the official mint coins like Silver Eagles and Silver Maples. So not too much of a change to report on this week as far as physical supply, availability, and premiums. But speaking on the physical side, Dave, in another of your recent articles, you kind of broke down and analyzed Ted Butler's recent claims that JP Morgan has been the entity buying up all the Silver Eagles in record quantities. And the Silver Eagle sales certainly have been breaking records or on pace to break records this year. Through mid-May here, we're nearing 21 million ounces of Silver Eagle sales. May is on pace to be the largest month of the entire year. Thus far, March's 3.4 or 5.4 million ounces have led the way, and we're already at 3.3 million ounces through the first 2 weeks of May. So if sales would continue, we'd be looking at possible 6 to 7 million ounces of sales in May, which would be an all-time record for May. But you pointed out that Ted Butler's claim that JP Morgan is the entity purchasing all these Eagles is pretty much nonsense and inconceivable. Do you want to elaborate further?
Yeah, well, first of all, I'm not really sure what motivated him to make that comment, because there's just absolutely no way you can document it. I mean, I can't even find any circumstantial evidence justifying making that assertion, unless he has inside information, in which case he would have told us. A little birdie told me. What's the famous line from the Drexel Burnham, Dennis Levine, Ivan Boesky days? Your bunny has a good nose, and he would have to at least add some validity to his assertion by telling us that he heard it on a good source or something. To begin with, the amount of Silver Eagles that we're talking about, when you convert it into tons, is really not. It's significant in that we're at a run rate that far exceeds the U.S. mine supply of silver on a monthly basis. But it's not a significant amount in the context of how much silver is mined every year, and how much silver is sitting in the COMEX vault, and how much silver is sitting in the SLV trust. And bullion banks deal in the global marketable bar standard, which for silver is 1,000-ounce bar. And to think that JP Morgan, because they're having trouble getting a hold of silver, would buy up Silver Eagles and recast them into 1,000-ounce bars, I mean that in and of itself is expensive, and it's a lot of trouble. And especially when you consider the fact that, hey, they've got all this silver they're reporting to be holding in the COMEX inventories, and there's 10 million plus ounces of silver sitting in SLV, or whatever the number is. It might be 10 million. I forget what the exact number is. But at any rate, I think part of where Ted Butler is making this assertion is that he refuses to believe that the custodians of the GLD and SLV trusts lease or hypothecate the metal that's being held there. And that's another absurd assertion to make, especially if you read through the prospectuses line by line. You can see that they were set up to enable hypothecation of the bars. So JP Morgan has all the silver it wants sitting right under its nose as the custodian of the SLV trust. I don't know why they would bother with 1-ounce Silver Eagle coins. To me, all the evidence is there that it's the public who is starting to get a wider understanding of what's going on in this country, what's going on with the currency, and the importance of converting your Federal Reserve notes into physical gold and silver. And historically, Silver Eagle sales have gone to the public, and I see no reason why that's changed. And one evidence that I have is a recent article on the silver market that I published on Seeking Alpha, within 5 days, had by far the most amount of hits that I've had on any article that I've published on Seeking Alpha in the last 18 months, by far. And I've had more email inquiries about silver, how to buy it, what my view is on it, etc., than at any point in the last 18 months. And to me, that tells me, that's just indicative of the fact that the average person out there is starting to get it and is starting to understand the need to buy gold and silver. And obviously, historically, silver has been the poor man's gold. If you can buy 68 ounces of silver for the same price that it would cost you to buy an ounce of gold, you're going to buy the silver. And ultimately, if we get back to a sort of a basic economy where we're using gold and silver as currency, silver is much more fungible than gold. It's more practical for individuals to hold. So I just think it's kind of a crazy assertion to make that J.P. Morgan would bother accumulating silver eagles, so that it could recast them into bars, when all the evidence for me suggests that the public is becoming more and more interested in precious metals, and especially silver.
And from a precious metals retail dealer's perspective with SD Bullion, I can substantiate that J.P. Morgan is definitively not purchasing silver eagles in volume. Maybe one of their employees is buying a tube or two, but they're not buying them in volume. A couple other points I would throw in. Yeah, maybe a part of Blythe's severance package. She got a couple tubes. But you're seeing premiums at their all-time lows. We were selling silver eagles for $239 over spot, any quantity for 2 weeks. And if J.P. Morgan had suddenly come into the market and purchased 20 million silver eagles, premiums on silver eagles would be between $5 and $10 per coin. So not only is it absurd to think they would, which I agree with, if they were going to purchase silver in the market, they'd be buying either 100-ounce or 1,000-ounce bars back into the market, that they'd be paying maybe 20 to 40 cents over spot in volume versus an eagle that they're not going to get under 225 to 240 over spot. So not only is it absurd, but you're also not seeing any market evidence of a new buyer in size coming in, which would affect the premiums and availability and supply. Silver eagles would be in massive shortage because the retail demand, as you mentioned, Dave, is at record highs. It's there, and if we had a new source of 20 million ounces of demand of silver eagles, we'd be seeing massive shortages and the highest premiums in silver eagles we've ever seen. And instead, we're seeing some of the lowest premiums possible with the U.S. Mint sales prices.
That brings up another point, Doc, that I just thought of as you're mentioning the dealer aspect of silver eagles. I believe the way the mint sales work, I believe there's 4 authorized participants that buy.
Right, there's authorized purchasers. So number one, J.P. Morgan could not just purchase from the mint. If they wanted to do it, they would purchase from all the authorized purchasers, and I would know that for a fact because they'd be telling me we don't have any because J.P. Morgan just bought 5 million from us. So.
Well, that was the point I was going to make. I mean, the word would leak out.
Oh yeah, exactly.
It would leak out through the authorized purchaser / dealer relationship network that it was J.P. Morgan who's coming in and buying the silver eagles. We would already see articles with direct quotes, and all we're seeing on the matter is Ted Butler making some assertion in a newsletter that he sells.
Yeah, and unfortunately, it's actually kind of convoluted logic. It's like you wouldn't see Safeway or Kroger or whatever going to McDonald's to buy Big Mac to accumulate a bunch of hamburger to sell to their customers. I mean, it's like, why reinvent the wheel? J.P. Morgan has existing relationships from their investment banking and bullion banking world that dwarfs the Sunshine Mint, the primary supplier of the U.S. Mint's Silver Eagle program. So, if we would see pressure from J.P. Morgan impacting the Silver Eagle program, it would show up in the actual bullion markets and Sunshine Mint tucking their tail between their legs saying, gee, U.S. Mint, sorry, we can't find enough silver, and you're going to have to, put everyone on allocation and do all the things that you've done in the past when the silver market got tight and you disappointed your customer base. I mean, that's what we've seen in the past when silver market was tight and this time around, there's enough silver for the U.S. Mint to crank it out and meet the really strong demand right now. But I don't think there's any linkage here. It doesn't make a lot of sense. So this is kind of like when Ted Butler many years ago, I think it was in 2007 or 2005. I'm not exactly sure, memory fails, but he had suggested that China was the primary short in the silver market. And people have said that subsequent to the fact. Even James Rickards was talking about how China is the primary or the possible main short in gold because, if he was investigating as a homicide investigator and saw a dead body, he'd try to look for who has the best motive and then proceed further. And that was how he explained his logic. But anyone who's done enough research in this manipulation game over the last decade plus can see that China's playing a role, but they're not the primary short in either of these markets. And like Ted Butler's analysis about, or suggestion perhaps is better said, about the Silver Eagle JP Morgan link, I think it's just kind of specious on the surface.
And the one other topic in the physical aspect I want to touch on here before we wrap up the show, again in the East in India, where the elections have wrapped up, and as we've been anticipating really for a month or two, Narendra Modi's opposition party has swept the Indian election. I'm actually kind of surprised gold hasn't traded stronger the second half of this week on that imminent announcement. The Indian market is up. So, and for those who haven't been following the story, Modi is very pro-gold versus the current administration, who is at the behest of the Western bullion banks and the Federal Reserve System, instituted a number of restrictions on gold imports and in attempts to keep the Indian public from purchasing gold. And Modi is very pro-gold, and at least in his statements and speeches and campaign promises, he is going to eliminate all of those restrictions on gold. So if that does...
a good percentage of them.
Right. So if that does play out, that's likely the most bullish factor we've seen in gold in several years, in my opinion.
Yeah, well, every time we have something on a geopolitical front or some event that's really positive for gold, it's not uncommon to see the cartel step up their action of squashing the price action, and that's exactly what we've seen this week. I mean, anecdotally, the pattern fits the pricing pattern, and when the cartel has been active in the last 2 days, today and yesterday, fits the news with what's going on in India. India also has a really large jewelry export business. And they're not just looking at it from the perspective of free markets being better than not. They're also looking at the reality that a lot of business activity has been hurt in India. And people first and foremost look at the issue of gold inflating the current account problems in India and whatnot. But they're losing a lot of exports too when it comes to what they produce for the rest of Asian jewelry demand. So I believe that they're going to try to at least reduce the restrictions by about 2/3 over the remainder of this year, and hopefully that'll happen, and then that'll be a big boon for gold. There's one other topic that I think that we should toss out on the economic front. We had the Michigan Consumer Confidence Index reported today. It was a big negative surprise that goes back, maybe to 2006 in terms of the disappointment. And this fits in with a pattern that Dave has been talking about a lot in his coverage of the real estate market and economics in general, about how everybody was saying, the problems that we were having before was just because of the really cold winter. And lo and behold, confidence did shoot up 2 months ago in the report, but now we're seeing a really big negative surprise. And it corresponds with slowdown, turn down in momentum sectors of the stock market. And last week we were talking about that, and also how the really high-end art market has even begun to hit a speed bump. And so there's a lot of indications that that whole thesis of a summer slowdown is still on track. And the Consumer Confidence Index report confirms what we were talking about last week. So I just wanted to put that out as a footnote. And too, the bond market is really sending pretty ominous signals. The long end of the bond market, seeing yields plummet to levels that are truly surprising, and maybe that does correspond to the extra effort that the Federal Reserve is doing with swap lines in Belgium and cahoots to purchase bonds and push yields down. Who knows? But it's really weird when you see only a month ago that we were really strong in even momentum sectors of the stock market and whatnot, but now we just continue to plummet lower and lower in bond yields as if there's this gigantic fear of a deflationary bust on the horizon or a big economic slowdown or whatnot. Some of it's flight capital, to be sure. The people in Ukraine and whatnot are not going to be taking their pilfered millions and billions and whatnot and sticking it into the bank accounts, given that we're in a new world with banks not being secure, so people do put some money into treasuries amongst hard assets and other stuff. But I'd love to know your take, Dave, on what you think about what's going on in the bond market, because it's really peculiar to see the yields continue to fall, prices going up on 10-year and 30-year and whatnot. I mean, last week, in looking at the prices, it looked like we might have seen the reversal of that trend. But here we are again at this week on Friday, where yields have been falling throughout the course of the week. What do you think is going on here?
Well, there's a couple factors there. The first one is if the Fed's narrative that the economy is getting better had any substance to it, we would see not only yields going higher, but we would also see the curve steepening. And what we're seeing is that yields are going lower quickly, and the curve is flattening. Part of that is being driven by there's a big short squeeze going on in the long end of the curve. I went and looked at the numbers this morning, and if you look at the Commitment of Traders report, the managed, what would be the equivalent of the managed money category, has built a huge short position, a net short position in relationship to where it was at the beginning of 2013. Before I looked at it in 2013, also way before the QE tapering was even a figment of anyone's imagination. And so the obvious trade has been, okay, the Fed's going to reduce its bond purchases, so we need to short the Treasury market. So there is a little bit of a short squeeze aspect going on there. But I think, as you said, when you see a compression like this in the yield curve, both outright and also in terms of flattening, it means that the bond market, which is typically the smartest of all the markets, is smelling something very ugly behind the scenes that's coming our way for our economy. And we're already seeing that in the numbers, obviously, as you were talking about the sentiment and the retail numbers and the housing market numbers. But yesterday I also was looking at the very short end rates, and basically from 0 out to 3 months, we're basically at 0%. When you take into account transaction costs, if you park your money anywhere out to 3 months, you're basically not making any interest. It's a 0% rate. And the reason why you do that is if you have a big chunk of money that you just want to set aside and hold it as cash, you're going to put it in very short-term treasuries as opposed to holding it in a bank. Because if you hold it in a bank, you're only insured up to whatever the number is now. I think it's $250,000. If you got several million that you want to just hold as cash, you know that you're at risk by putting it in the bank beyond your $250,000. If you put that kind of money in short-term treasuries, you know the ultimate backstop is that the Treasury will just print money in order to pay off those bonds. So your cash is safer. And really, the last time the Treasury market was behaving like this was in the spring of 2008, right after the bear blow up and a couple months before Lehman and AIG and Goldman blew up. So I do think there's a real distinct possibility that what we're seeing in the behavior of Treasury market yields is suggestive of something really ugly coming at us through the system. And what that is, or if it is, we'll probably find out well before the end of this year.
All right. Well, I think that's a good place to wrap here. So if you haven't checked out Dave's news site, it can be found at investmentresearchdynamics.com. So Dave continued to publish excellent commentary on the markets there. So we encourage all of our readers to check that out. So
one point that I want to just throw in there with my site, one of the things and one of the reasons why I changed it over to this site is that I'm going to start offering for a very small fee research on individual mining stocks and other special type situations. And I'm just going to start off selling it on a report by report basis. I've had a lot of inquiry for that, which is why I'm rolling it out. And it should be up and running, if not this weekend, by early next week.
All right, we'll look forward to that and check that out over at investmentresearchdynamics.com. So for the Doc and Eric Dubin, thanks for tuning in to the SD Weekly Metals and Markets, and thanks for joining us today, Dave.
Thanks for having me. I always have a good time with you guys.
The Doc's new investment option.
Lead bullion.
Buy your ammunition from the Doc today at sdbullion.com.